So the last video I made talked about the latest SAVE updates with the government using 5% of the discretionary income formula to calculate now for undergrad loans, and some people might be on pause while the government recalculates this. Please watch the full video that has already been posted. I will link it in the description. This video I want to discuss when is SAVE not right for people. I think that's really important. I also want to include some specifics that I did not include in the last video that I should have included. I put them in the specifics in the description of the last video. I just didn't talk about them, and I do think they're very important so that people can make the right decisions for them, okay? First and foremost, SAVE repayment period changes based on how much you borrowed, okay? I did talk about that briefly, but I did not talk about the specifics. So if you went to undergrad and you borrowed under $12,000, the maximum payment length is 10 years. If you borrowed more than $12,000, essentially, if you borrowed more than $12,000, your repayment length will rise by 1 year for every additional $1,000. I think I said 11,000 last video, so let me correct that. So 11,000 is still correct. So if you borrowed 11,000, you get 10 years. So what I said isn't false, but the limit is and the cap is actually 12,000. And so for every 1,000 additional dollars, so let's say you borrowed 13,000 for undergrad, your repayment period is 11 years, right? Or if you borrowed 14,000, your repayment period is 12 years. 15, 13 years, 16, 14 years. 17, 15 years, 18,000, 16 years, 19,000, 19 years, 20,000, 20 years. Maximum for undergrad is 20 years, even if you're not a public servant. If you have grad school, and it's significantly higher, it expands to 25 years, okay? Because people borrow the most debt in grad school. So I just want to specify that. That's what I actually don't like about SAVE, is the changing amount of years you have to pay based on how much you borrow. I think it's confusing. I think it's hard enough for people to track when there's a straight 10-year or 20-year, let alone moving targets, right? So I'm not a fan of that, but that's the reality of the program, okay? So I wanted to mention that. And that's a disadvantage, but of course the advantage comes that your payments get reduced, and they recognize grad school and undergrad loans differently. You have a higher percentage to pay if you're graduate loans of 10% and a lower percentage of 5% of discretionary income, excuse me, if you're undergrad loans. Additionally, so I wanted to talk about those few differences. Now, let me go into what I wanted to create the content of this video about, which is what are the disadvantages of enrolling in SAVE? And if you are on pay as you earn, should you switch to SAVE? Okay, that's important. Or if you're on standard, even like a standard fully amortized, you pay everything off in 10 years, should you consider switching to SAVE? First and foremost, I always like to ask people, what are their goals and what are their financial capabilities to pay their student loan? For example, everyone's switching into SAVE because it's like the thing, like people just automatically say, I should switch into SAVE. But that's not necessarily the right path for you, especially if you are either a high earner, because SAVE does not cap your payment. So let's say your full 10-year payment is $800 a month, okay? And even though SAVE will reduce your payment if you earn lower amounts of money, let's say you earn $50,000, SAVE will significantly cap your $800 payment down because the government does not think at $50,000 you earn enough to pay an $800 per month payment, so your payment will be decreased. Just so SAVE may be appropriate for you. But let's say you earn $200,000, right? The disadvantage of SAVE is that there is no cap to your payment. So if your payment, let's say you graduate from undergrad, you earn $50,000, but you go back to grad school and now you can earn $150,000, $200,000, $300,000, then being on the SAVE program ultimately maybe not be the right path for you, right? Because your payment is just going to incrementally increase as your income increases, okay? So let's say you expect a 2 to 3x income jump when you finish grad school a couple years out from undergrad. Maybe enrolling in SAVE may not be best for you. While you can enroll in pay as you earn may be great if you don't know if you're going to go to grad school, when you're going to go, and you can't afford the full 10-year payment, I like to tell people, if they're unsure, enroll in Pay As You Earn, because if you enroll in Save, you can't go back. You can't go back into Pay As You Earn starting literally in July of 2024, I believe is the deadline here. Let me see. If you're in the Save program, you're not eligible to re-enroll in Pay As You Earn or the ICR plan after July 1st of 2024. So again, you can switch from Pay As You Earn into Save, but you cannot move from Save to Pay As You Earn. So it's really important to understand that. If you have high income potential or high or accelerated increase in your income in the near future, do not enroll into Save. If you want to aggressively pay off your student loans after you buy a house or have a goal that you want to pay for your wedding, then you're going to aggressively pay for your student loans. Whatever your future goals are, take that into account. It is not a one straight shot answer, everybody enroll into Save right away. That's not the right answer for everybody. We like to recognize that. Another thing is like, if you're going to buy a house, you want to enroll in Save. The type of mortgage loan you take out, you need to take into account, because if you get a $0 student loan payment, that may not work out for you, especially if you're an FHA borrower. So keep that in mind. Understanding the mortgage loan, understanding what your payment's going to be, that matters. And then let's say you buy a house, you enroll in Save because that's right to close on your home, but now you want to pay it off. It's also great to talk to someone if you have a complicated financial plan, like you're buying a house, you're getting married, you're starting a family, and you want to understand what your options are as you get married and file your income taxes jointly, especially. It's really important to understand what's going to happen with your student loan. If your spouse has student loans, that and filing joint can have a huge impact on what each one of your payments can be, okay? So I just want to put that out there. Whether you and or your future spouse or current spouse should be enrolling into Save are all questions we can help answer. Also with understanding your future and projected income growth as a family, okay? So I want to put all that out there. So again, Save is not right for you if your income's going to go up significantly. You're planning on enrolling in grad school, 2 to 3xing your income after undergrad. If you want to pay off your student loans aggressively, Save may not be the right option, although if you enroll in it now and want to pay off your student loans aggressively in the future, that is possible. So again, case-by-case scenario, but just want to put it out there. Save may not be right for you, but also if you enroll in Save, you cannot go back into another program like Pay As You Earn starting July 1st of 2024, okay? I hope that information was helpful. There are amazing benefits to Save, including year-over-year interest forgiveness, okay? I will never want to forget about those benefits, because those benefits are very important. There's no more what's called negative amortization, which means whatever you don't pay keeps on accumulating and accumulating year over year. That's going to stop with the Save program. So there are amazing benefits to Save, but just know Save may not be right for you under the scenarios I talked about. If you missed my update on the discretionary income formula changes taking place in July, I highly recommend you check that out. The link is somewhere around this video, either here in the description. Please check that out. Again, like, share, subscribe. Let me know if you have questions or comments. I am eager to answer them. Have a great day.